Is there ever a time to be precise? Now is the time. Hello and welcome to GITIXONE trading channel, where I share tips and tricks on how to trade forex like a pro. In this video, I'm going to show you how to combine Fibonacci retracements with the concept of fair value gaps, one of the most powerful and effective tools for price action trading. But before we get into that, make sure you hit the subscribe button and the bell icon to get notified whenever I upload a new video. If you find this video helpful, please give it a thumbs up and leave a comment below. I'd love to hear from you. Previously, we discussed the basics and a few tips on how to use the Fibonacci tool in trading effectively. If you have not watched that video, please check the link in the description of this video and watch it before you watch this video. Today, we shall look at how to combine it with a fair value gap. Now, let's talk about fair value gaps, or FVGs for short. FVGs are anomalies in the market, signaling imbalances between buying and selling forces. These gaps manifest in a three-candle sequence on price chart, creating a distinctive pattern. The psychology behind the fair value gap is that these gaps emerge due to inefficient price delivery. Fair value gaps occur when there is a notable disparity between buying and selling pressures, leading to substantial price movement and leaving discernible gaps on price charts. The concept of fair value gap goes by different terminologies among price action traders and is rooted in the belief that the market inherently corrects itself, gravitating back towards these imbalances before continuing in a direction of the initial impulsive move. So, how do you identify a fair value gap on a price chart? It is very easy. All you need to do is look for a three-candle formation that meets the following criteria. 1. The first candle is either bullish or bearish, indicating the direction of the trend. 2. The second candle is a large candle, either bullish or bearish, indicating a strong momentum in the same direction as the trend. 3. The third candle is either bullish or bearish, indicating a strong momentum in the same direction as the trend. This candle creates a gap between each wick and the wick of the first candle, which is the fair value gap. Future prices are expected to return within the gap created by the third candle, which is the FVG, before continuing in the same direction. Here is an example of a chart with a fair value gap in an uptrend. As you can see, the first candle is bullish, indicating an uptrend. The second candle is a large bullish candle, indicating a strong upward momentum. The third candle is a bullish candle, indicating a strong upward momentum. This candle creates a gap between its low and the high of the first candle, which is the FVG. You can see the price returning within the gap created by the third candle for a continuation of the upward trend. Here is an example of a chart with a fair value gap in a downtrend. As you can see, the first candle is bearish, indicating a downtrend. The second candle is a large bearish candle, indicating a strong downward momentum. The third candle is a bearish candle, indicating a strong downward momentum. This candle creates a gap between its high and the low of the first candle, which is the FVG. You can see the price returning within the gap created by the third candle for a continuation of the downward trend. In an ideal scenario where prices are properly delivered and there is no fair value gap, this is how the three candles are supposed to look for a bullish or bearish scenario. You can see there are no gaps between the wick of the first candle and the wick of the third candle. Hence, there is no fair value gap. Now that you know how to identify Fibonacci retracements and fair value gaps, let me show you how to combine them to create a powerful trading strategy. The idea behind this strategy is to use the Fibonacci retracement levels as entry and exit points for trading the FVGs. The FVGs, fair value gaps, indicate the potential key zones in the market, while the Fibonacci retracement levels indicate the potential support and resistance levels in the market. By combining these two tools, you can increase your accuracy and profitability in your trading. Here is how the strategy works. First, you need to identify the trend direction and the FVGs on the chart. You can use any time frame that suits your trading style, but I recommend using at least a 15-minute chart or higher for better results. Second, you need to apply the Fibonacci retracement tool to the FVGs. You can use any Fibonacci retracement levels that you prefer, but I recommend using the 0.382 or 0.5 or 0.618 levels, as they are the most commonly used and respected by the market. Third, you need to wait for the price to retrace to one of the Fibonacci retracement levels within the fair value gap and look for a confirmation signal to enter the trade. The confirmation signal can be a candlestick pattern, a chart pattern, an indicator, or any other tool that you trust and use in your trading. The confirmation signal should indicate a continuation of the trend, not a reversal. Fourth, you need to set your stop loss and take profit levels for the trade. You can use a fixed risk to reward ratio such as 1:2 or 1:3, or you can use the Fibonacci retracement levels as your target. For example, if you enter a long trade at the 0.382 level, you can set your stop loss below the 0.618 level and your take profit at the 0 level or the previous high. And if you enter a short trade at the 0.618 level, you can set your stop loss above the 0.382 level and your take profit at the 0 level or the previous low. Here is an example of a long trade using this strategy. As you can see, the price was in an uptrend and it formed a fair value gap. I applied the Fibonacci retracement tool to the fair value gap and waited for the price to retrace to the 0.382 level, which acted as a support. I looked for a confirmation signal, which was a bullish engulfing candlestick pattern, and entered a long trade at the close of the candle. I set my stop loss below the 0.618 level and my take profit at the 0 level or the previous high. As you can see, the price continued its upward movement and reached my take profit level, giving me a nice profit. And here is an example of a short trade using this strategy. As you can see, the price was in a downtrend and it formed a fair value gap. I applied the Fibonacci retracement tool to the fair value gap and waited for the price to retrace to the 0.618 level, which acted as a resistance. I looked for a confirmation signal, which was a bearish engulfing candlestick pattern, and entered a short trade at the close of the candle. I set my stop loss above the 0.382 level and my take profit at the 0 level or the previous low. As you can see, the price continued its downward movement and reached my take profit level, giving me a nice profit. So, these are some examples of how to combine Fibonacci retracement with fair value gaps to create a powerful trading strategy. Of course, there are many variations and combinations of this strategy, and you can experiment and find what works best for you. But before you do that, let me give you some tips and best practices on how to use this strategy effectively and avoid some common pitfalls and mistakes. The first tip is to use this strategy only in a trending market and not in a rangy or choppy market. The fair value gaps indicate the potential key zones in the market, but they are not guaranteed to work. If the market is not trending, the price may not respect the Fibonacci retracement levels and it may break through them or bounce between them. Therefore, you should always use a trend indicator such as a moving average to identify the direction and strength of the trend and avoid trading against it. The second tip is to use this strategy only in a high volatility market and not in a low volatility market. The fair value gaps indicate the potential reversal zones in the market, but they are not easy to spot. If the market is not volatile, the price may not create large gaps or candles and it may move slowly or sideways. Therefore, you should always use a volatility indicator such as the average true range (ATR) to measure the volatility of the market and avoid trading when it is too low. The third tip is to use this strategy only in a high liquidity market and not in a low liquidity market. The fair value gaps indicate the potential reversal zones in the market, but they are not reliable. If the market is not liquid, the price may not reflect the true supply and demand, and it may be manipulated or influenced by external factors. Therefore, you should always use a liquidity indicator such as the volume to gauge the liquidity of the market and avoid trading when it is too low. The fourth tip is to use this strategy with caution and not to overtrade or risk too much. The fair value gaps indicate the potential reversal zones in the market, but they are not risk-free. If the market is unpredictable or irrational, the price may not follow the expected pattern and it may go against your trade. Therefore, you should always use a proper risk management system and set your stop loss and take profit levels according to your trading plan and strategy. You should also be disciplined and consistent and not let your emotions interfere with your trading decisions. So, these are some of the tips and best practices on how to use this strategy effectively. I hope you found this video helpful and informative. If you did, please give it a thumbs up and leave a comment below. And if you want to learn more about forex trading, make sure you check out my other videos and subscribe to my channel. Thank you for watching, and I'll see you in the next video. Happy trading.